Roland, we hear a lot about China, particularly how important it is to Australia. What's your view of where China's at the moment?
China it's in an interesting place. The economy is growing very rapidly, but it doesn't necessarily mean you'll find great investments. So I've done 2 trips to China this year, and I came back away from both of those saying I don't want to send my money there. I'm very long on the Chinese economy. In other words, I think that it will continue to grow as people go from basic subsistence essentially to chasing consumer goods. But if I look at the Chinese consumer, which everyone's hoping is going to save both China in terms of having a soft or hard landing as well as the Western markets, I think they're going to be surprised. A lot of Chinese consumers essentially are healthy but absent. They're saving 30–40% of their money, so they're not spending it yet. And no matter what the government does, they're not necessarily going to go out there and start buying a lot of goods in the economy. So if you look at the Chinese economy at the moment, it's very massively imbalanced to investment. There's an inordinate amount of their GDP that's spent on investment, and that's not going to be around forever.
Yeah.
With GDP, investment portion of GDP at an unusual high, and the Chinese consumer really not stepping up, it's not necessarily a great place to be if you're betting on them saving the economy. And a place I visited earlier this year was Xinjiang City, which effectively makes sports shoes. Now there's a case where a lot of the companies we saw are growing from 2,000 stores to 2,500 stores, or 7 to 7,500, 8,000 stores in 1 year. And they're going to go through their first tightening phase ever, and it's because the Chinese consumers aren't spending money. At the same time, you've had a lot of new companies start up, and they're in competition with each other. So there's 5 or 6 large brand name shoe companies in China that want to be the next Nike or Adidas, and there's another 7 or 8 in the wings that want to take their place in a time when there's a tightening occurring. Now, they're going to face competition and consolidation for the first time, so there's been a massive inventory build, and for the first time in their listed history, they're going to be reporting negative growth. And that potentially translates into losses for a lot of these companies, where previously they had 30% margins. What's that mean? Well, normally you look at these companies and go back in history and say, how did these companies do in their last downturn? And what's really scary is a lot of these $1 billion, $2 billion market cap consumer companies, in this case, they didn't exist 4 or 5 years ago. So they went from a few dozen stores back in 2002, 3, 4 to having several thousand stores now. And so they don't have that history of what do I do with increased competition and slowing demand. So there's no history. So if I look at a lot of Chinese companies, they're in a similar position where they didn't exist, certainly as a listed entity, more than 4 or 5 years ago. And they've never gone through a cycle where things got really tight. During the GFC, when China was potentially facing a cliff from lack of Western demand, the government really induced a large amount of stimulus that's now wearing off. So for us, we can be excited about China at a macro level, but not necessarily excited about Chinese stocks at a micro level.
Yeah.